Hi everyone, it's Hasi from Porter Matthews Metro and Team Spicy. Today I'm at Ardent Advisory. Coming to the end of the financial year, I thought I'll interview my trusted advisor, Addy from Ardent, about some pertinent questions that we get asked around this time of the year. Let's listen to what he has to say. I'm here with Addy, one of the founding members at Ardent. Addy's been helping us for a very, very long time. I trust him with my own stuff, and he's been very kind to lend his time and knowledge this morning.
Thanks, Hasi. Guys, my name is Addy Desai. I'm a founding partner of Ardent Advisory with my business partner, Shane. We've been looking after Hasi's personal stuff and that of Porter Matthews Metro for a few years now. Really like to see what Hasi has done. He practices what he preaches, and he's built his wealth through what he does best.
We're going to be covering three topics that everybody's been asking me. Number one, negative gearing. Everybody loves to learn a little bit more about negative gearing. And another very important for these days as well, investments. Is it important to buy through your personal names or entity? And the other great thing about having a professional like Addy is tax planning. The importance of tax planning prior to doing your tax in the future. So let's listen to Addy and see what he has to say.
Thanks, Hasi. Guys, before we start, there's a disclaimer. What I'm going to try and explain today is just so that you can conceptually understand how negative gearing works. Your personal circumstances are not being considered here. You should seek advice from a qualified professional accountant before you make decisions that will impact you financially. This video is purely from an education point of view and does not really consider what your circumstances are. So let's get cracking. What is negative gearing? Negative gearing is something quite unique to Australia. There are a few other nations that have it, but it's in a sense, it is something that's unique to Australia. I'm going to try and explain what that is and how conceptually it works. Let's say you go buy an investment property. So this is how I think an investment property looks. Clearly, I'm an accountant, not an artist. But let's say you go buy this as an investment property and for a few dollars. Now, what then happens is there are expenses that you would incur with this investment property. The expenses being, one, the interest on the mortgage. That'd be rates and taxes. That'd be insurance. That'd be management fees that you'd pay a property manager to look after your biggest investment. And there might be strata and maintenance. Now, these are expenses that you would physically incur to manage and look after this property. Now, let's assume that you go find a nice young family to live in this house and they pay you rent. They pay you rent and you pay these expenses. Now, let's assume, for example, that the difference between the rent that you receive and the expenses you pay is negative gearing. So, in a sense, if the dollars that you spend is more than the dollars that you receive, it is negatively geared. So let's assume, for example, that in this hour, we'll keep it really simple, we'll use round numbers. Let's assume that you get $500 of rent a week per calendar week, and your expenses are $600 per calendar week. What that really means is that to have this couple living at this investment property of yours, you are losing $100 a week. Loss, which equates to $5,200 a year. Now let's assume that we have, as an individual, as an investor, I have a job. Let's say I'm a policeman and I make $100,000 a year. Now, to keep things really simple, I understand that Australia has a marginal tax, we've got a marginal taxing system, but to keep it simple, let's assume that your marginal tax rate is 30 cents in the dollar. So the tax you would pay is $30,000 on a $100,000 salary, and you would walk home with $70,000. Now, how negative gearing works is that as an investor, you could then say that the $5,200 loss, actual loss that you have made in this investment property can be offset against your income here. Now, remember in the example I said you get $500, but you pay $600, so you're still going to be out of pocket $100 a week. That $100 has got to come from somewhere, which means you're employed, you're making wages, you're earning wages, and you've got other income to supplement this $100. Now, if this were to be the case, you would then go and say your income is no longer $100,000 less the loss that you have made, which is $5,200. So your income is 94.8K. That means that tax is of 30% of that would be $28,440. But remember, your employer has withheld $30,000, which means you get $1,560 refund because you've got this property. Now, if you were to look at the difference, is that you have lost $5,200 this year in your property, but you have gained $1,560 from the taxman as an additional refund. Now, why would someone lose $5,000 to make $15, $60 from the taxman? Why would someone do that? There are two reasons why. One is that you believe that this property that you have bought is going to go up in value, and you are locking in a price at a date today, and in a few years the value would be far more. So in this example, the loss that we have got, about $3,000 of cash loss, we are saying that in 5 years my property is going to be worth far more than what I paid for, which is that I am going to have better capital returns. That is the first reason. The second reason why you would do is we have not accounted for depreciation in our expenses here. What is depreciation? Depreciation is the value of the property that declines over years. Now, this property that we have initially bought, let's say we paid $600,000 for it, and let's say it's a fairly new property, and we say the house on it is worth $300,000 and the land is worth $300,000. Over a period of time, the value of the house keeps dropping and the value of the land keeps going up. This drop in value of the house can be used as a deduction against your income. What that means is, in this example where we've lost $5,200, and let's say if the value of this is $300,000 property goes down in value, and we say the depreciation is at 2%, which means you could have a non-cash expense of $6,000 additional. What that means is now your loss is no longer $5,200, but it's $5,200 plus another $6,000. It's $11,200 per year. That means you would save, in this first example where we said the policeman earns $100,000 and pays 30% in taxes, he would save 30 cents of the $11,200, which equates to $3,360. Yeah? So that gives you 1,840 cash loss for the year to have an investment property which will go up. And the view is that that investment property of yours would increase more than $1,840 in this example that we've just used. So guys, that's why we do, that's why there are people out there who negatively gear properties, and that is to aim for capital appreciation in the long run. There are people out there who have built their wealth this way, So it is something, if you are thinking about doing, speak to a qualified accountant first, check your circumstances, speak to the property guys to see what's available out there and should you be buying it or not. Thank you. Let's assume that you bought this property for $500,000 in a trust, and let's assume in 5 years' time you sold it for $1 million. That are phenomenal returns. I'll take them any day of the week, but let's just assume for round numbers you made a $500,000 gain. So guys, let's use an example where you bought a property for $600,000, and let's say you sell it for $800,000 in 5 years. So we now have a $200,000 capital gain. In the first example that I previously used, let's say that you're still a police officer making $100,000 a year. And I said your marginal tax rate is 30 cents on the dollar. Let's assume that the trust has held this property for 5+ years, which is you are entitled to some capital gains discounting, and the gain on this property after discount is $100,000. So which means is you have to pay tax on $100,000 worth of income. If this property is held in a trust, the trustee, i.e. the controller of the trust, you get to decide who gets this $100,000. You might elect that your partner, who is in a lower tax bracket, get it, which means that in this instance, if your partner was also on 30 cents on the dollar, the tax on this gain would be $30,000. However, if you take the same example and have this same property bought by the police officer who's on $100,000 income, what that really means is that that income cannot be distributed out to anyone but has to go to the police officer. If we use the same example, he has $100,000 income, he's got another $100,000 of capital gains. What that means is it puts him to a higher tax bracket, which means he'd be paying, in this example, let's say if he's on 45 cents in the dollar, which means he'd be paying $445,000 in tax versus a $30,000 tax if the wife had paid for it. Now, this is the reason why, one of the reasons why people buy properties in trust. One, asset protection, and two, to lower the overall tax impact over the life of the asset. So there are some advantages there. What are the disadvantages? The disadvantages are, one, it's expensive to set it up. There is a big fee. There is a fee that's involved to set the structure up. Then there's a yearly maintenance cost for the structure. That is an expense that you still have to incur. And third, the biggest downside is the losses are trapped in the trust. So in the previous example where we had this negative gearing, where we could offset any of the losses against the individual's income, in this example, the trust would be unable to distribute losses. So the losses get trapped until such time that the property becomes positively geared from negative gearing, and then you can slowly start to use those losses up. So there are some advantages and some disadvantages, but it would really depend on your personal circumstances. So chat with your trusted advisor and see what's best for you.
Thanks so much, Eddie. So much valuable information, and really shows the importance of planning before you jump into investing anything, property, shares. Please pre-plan, speak to your advisors, get the right structures in place. So Eddie, please explain to us the importance of tax planning.
Sure, Hasi. Tax planning as a concept is what you're trying to achieve is to figure out what your marginal tax rates are and what your tax position is likely to be before the end of financial year. Once you have that valuable information, then you work backwards and see what are the things that I can do to, one, lower my tax bracket or my tax exposure, or maybe even it might just be that I want to increase my tax exposure for different reasons because the following year I might have some huge capital gains or whatever the reason might be. So you have to sit, plan with your trusted advisor, and by design come up with a plan to figure out what that would look like. Now, that could entail many things. It could be prepaying your interest. It could also mean putting some money into superannuation. I'm not suggesting any of these are right for you. This is just this is something that you have to speak to your financial planner, your trusted advisor, and then see what's right for you. But tax planning does enable you to know what your tax exposure is 12 months in advance almost, and also gives you the ability to plan for it from a cash flow point of view.
Thanks so much. So what I've really learned in my time in real estate is planning. Get the right team around you. Settlement agents, advisors like Addy, real estate agents, get the right team around you. So when you look back, look, you're not gonna, no one wants to pay too much tax, right? That's the whole thing. And when you do retire, you're gonna have a smile on your face. So thank you so much for watching. Guys, I cannot recommend Addy highly enough. He's been helping my family and the company for a very, very long time. You can trust him. Please get in touch with Addy at Ardent Advisory. I'm sure he's got the right advice for you. Thanks, Addy.
Thank you, Hasi. Pleasure.